Hello, everyone. Thank you for joining CryptoQuant's Twitter space. I'm Ho-Chan, who will be moderating the live streaming. Today, we'll be discussing on-chain 2021 retrospective and looking into 2022 with beloved on-chain analyst David Puell, our CEO Key, and CQ verified authors Barak Tamak, Crypto Wizard, and Jan Ustenfeld are also joining today's Twitter space to ask questions and to have a discussion with David Puell here. Today's session would be a 1 hour long, composed of mainly two parts. First half would be David Puell's share on his perspective of on-chain 2021 retrospective, looking into 2022, and second half would be a discussion with David Puell and CQ verified authors. If you have some spare time, we'll also take a few questions from listeners as well. So stay tuned until end of the Twitter space. Now, let's all welcome David Puell.
Hey, how's it going? Thanks for having me, guys.
Great to have you.
Hey, David, what's up?
Hey, how you doing? Nice to see you again, Key.
Hi, David. Great to have you on.
Hi, David. Nice to see you here.
Hello, everyone. Hello to all listeners and also Dave. It's great to have you here.
Excited as well. Let's get this going.
So, David, what do you think about what have you prepared for the on-chain 2021 retrospective and looking into 2022?
Pretty broad question, but I guess few things. We see a much more diminished year in terms of volatility. I think that plays out into how institutional players integrate themselves into the market. We also see a new, let's say, a new distribution of cohorts, at-risk cohorts, in terms of what's becoming. So at this point in time, I guess you would have three different types of players in the Bitcoin, specifically in the Bitcoin market. I guess the first one would be mainly OG early adopters who still hold a lot of the balance, the total balance of the Bitcoin circulating supply. Then the institutional players, who in proportion have less market share, you could say. That's mainly because of the timing they got into the market, right? At that point, major, by today's standards, major whales had already entered the market in, different cycles, way back to 2013 or 2011. And then just retail, as always, one of the main drivers, with a much more diminished, let's say, participation in the market. 17, right? If we see the later stages of 2017, it was a huge market driven by retail, irrational exuberance at the later stages of the ICO boom. That has diluted at this point. So the market is driven by mostly OGs or profit taking, pretty on the heavy side since 2018, even early stages 2018. And then the market movements have been mostly up and down by the new institutional adopters, who are pretty much, they behave much more like you would expect a traditional market, in the sense that tops and bottoms are perhaps more produced, intertwined by events of volatility to the upside and downside, and then huge periods of or long periods of accumulation or distribution for several months, right? I mean, during the year, basically, we had, I guess, at the beginning of the year to the upside, and then around May to the downside. Not that common for Bitcoin historically to be so reduced in terms of ratioing consolidation versus trending movement. And that pretty much is suggestive of how institutional players act in any given market. I expect that to continue to the future for sure. Even if we go back to just to last year, right, or 2019, which was extremely volatile, hard to trade, filled with gray or black swans all throughout. This year was much more, let's say, relaxed, and let's say it was easier to navigate, right? But I think that has also kept retail much quieter in relation to, let's say, 2017. We haven't seen that, proportional pump that always drives retail. So far, it hasn't happened yet, and it hasn't produced the later stage end of bull market filled with 2x, 3x increases in a few weeks. So that's interesting. We've discussed this also, a lot of on-chain analysts going back in the last few weeks. I think that the main aspect we're seeing, which is atypical to previous markets, is so we have a healthy amount of buying, very quiet and strategic buying whenever we have any major downside, but still a lack of momentum in network health related metrics. So let's say active addresses, hash rate, transaction count. All of those are not heavily related to, let's say, a specific buy or sell signal, because sometimes they decouple in correlation with price, or they're not as specific to generate, reliable buying or selling signals. But nonetheless, in aggregate, they show a confluence of lack of activity relative to price, what we would expect to a later stage bull market. For people who are new to the space, December, the December month, perhaps the January month, in any bull market, at least in the few samples we have, is those are moments of extreme volatility to the upside. I think this is long-term healthy. It denotes that the market's going to be mostly owned by institutional players, especially in month-to-month price movements, with some profit taking from early adopters, but a much more diminished role coming from retail players who perhaps don't find that they don't find attraction to Bitcoin per se, maybe to other assets a little bit more, but to Bitcoin in terms of the lack of price volatility they would expect to the upside, like they did in 2017. But that also prevents perhaps more sustained or corrective periods of full-blown bear markets that last from a year to 3 years, as we've seen before.
So you mean the increasing of active addresses could indicate we're kind of bullish right now, because there are many users, like retail investors?
I usually don't use, let's say, specifically one single metric like active addresses, right, or hash rate or transaction count. I'm not a fan of using them as a single mechanism for generating biases. But in aggregate, if you compare the current environment to previous, you do see a lack of, let's say, network activity compared to, perhaps not to price specifically, current price, but to the activity we usually relate to a later stage bull market, assuming we're in a cyclical market, right? Like most people speculate, or a lot of people speculate, meaning the 4-year cycle, in great part driven by the 4-year halving that Bitcoin has, right? And all the crypto assets correlated thereof, just as a result, right? So active addresses perhaps in and of itself does not give you the great hint, but I'm noticing much more activity, let's say, buying activity at the exchange level. So for instance, if you go any aggregate of funding rates or perpetual expirational contracts, you create a delta between that and spot price. You see that for the most part, derivatives are negative or a discount. And that's usually indicative of extremely bullish behavior, because literally your asset, it's the asset itself, price discovery occurs in spot markets, right? So whenever your spot is more expensive than speculative contracts, that's very bullish. That's one of the most reliable signals we've had in the last few years. So there's been a lot of a suggestion of market buying at the exchange or liquidity level of the market. On chain is much more diminished. One of the theories is because since institutional players are the ones driving, let's say, midterm price movements, a lot of those transactions occur off chain, right? Although I still have doubts about that at this stage. That may be one of the reasons. And the other one is just indicative of the lack of interest in retail. It's just big boys, institutions or early adopters, who have a lot of experience in actively managing positions around any asset. But the trade-off is that you see a diminished, let's call it network momentum, which is usually driven by retail at the later stages of the bull market. So right now it's pretty atypical. For the people who stick to a cyclical market, 4-year cyclical market in Bitcoin, I mean, by now something different has happened already. It's completely atypical to see such a low volatility, yet healthy, right, market at the later stages of a 4-year cycle. That has never happened before. You always see, extreme irrational exuberance at these stages. So it's good in the long term, but it's not as fun, let's just say, for new investors who expect 2x, 3x pump in a couple of weeks, as they saw in 2017.
Makes sense. So I think basically Bitcoin valuation model has been changed, like based on its narrative. A few years ago, Bitcoin was a P2P payment system, right? So the number of transactions and number of active addresses is very important to evaluate Bitcoin network, like MVT ratio, I would say. But nowadays, you like you mentioned, the number of addresses and transactions are not that related to the price actions. I think basis ratio, futures price is more cheaper than spot price right now. I think it's a good thing for the long term, because it would indicate there are buyers in the spot market. But I'm pretty afraid of is that I haven't seen any new buyers in this market. Do you have any clues to see new money inflows to the market, like institutional buyers or retail investors?
For the most part right now, I'm seeing more holding than buying. And perhaps I see some reaccumulation. But yeah, that's the way I would put it. It's more holding than buying, and that's certainly not the same thing. I mean, holding pretty much sets floors, healthy floors for a corrective market. And if you have that mixture, let's say low distribution or selling, high holding but no new buying, the result is a sideways market, literally.
That's what's happening, right? No one is selling and no one is buying. That's why price is like going sideways.
Yeah, exactly. That's the result is pretty obvious. It's just more consolidation, which is healthy, for sure. The thing about an extremely prolonged period of consolidation, let's say, to give you an example, 2018, the first half of it, after the bubble, the ICO bubble in 2017. So the market collapsed from about 20K to, I think the first impulse was to 6,000, I believe, and then went back up to 10,000 and continued to range around the 6,000 mark, right? For, I think it was a little over 6 months. So it's a long period. Whenever you get that on any long-term chart, that severe, the severe period of low volatility, well, one, the market corrects either in price or in time, right? For any tone-based listeners, you already heard that, which is a very good rule of thumb, right? Whenever you have punishment in time or in price or a little bit of both, that's healthy. But the longer you have a low volatility market, the higher the probability that that market is going to be extremely expansive. And the first principles explanation for that is pretty obvious when you look at it. What happens? It's like a self-fulfilling prophecy in a way. So what you get, what you get in a high volatility market, the books get wiped. The bids and asks get completely wiped. People are much more risk averse during those periods. So they decide to stop, pretty much betting on the market or even on a spot price, right? But when you get low volatility, everything compresses around price. Orders, stop losses, bids, ask, everything compresses around price. So whenever you have a fundamentally strong event that impacts the market, you get a cascade of that always goes into the you never know what's enough until you know what's more than enough. So whenever you have low volatility, all the orders, all the speculation is extremely compressed around price. You get like any spark that sets that off, and it's like a chain reaction that produces a pretty huge pump or a crash. And we saw that in 2018, right? Volatility was historically low. I think it's all-time low that time. And the market collapsed from 6,000 to around 3,000, right? So that's the danger, right? Now, the other factor that played out that time and can still play an important role during this market would be you have the spot price and the expectations of it relate to volatility. Another thing that correlates with low volatility is high open interest. That happens specifically in Bitcoin, which is quite easy to track, right? So orders rise, and the speculation rises at moments of perceived low risk, meaning low volatility, and that in itself creates high risk, where open interest pretty much keeps rising, as we've seen. We're actually seeing that right now. And that sets off a liquidation event that obviously creates volatility. I mean, that's actually, for the most part, the effect that derivatives have in the Bitcoin price, even up to date. You can explain long-term to mid-term movements fundamentally via on-chain, spot price, spot behavior. But in the short term, let's say a correction, as we've seen recently, right? You can explain it in terms of liquidation events sets off by high open interest, right? That's the real effect that derivatives create in the market. It's not, a systemic risk in the sense that we're going to have there's no new bear market that you would get just out of derivatives. That's completely ridiculous. You get a bear market because no one's buying spot, right? But you can get a correction for sure, like the recent one, with high open interest. So if you get the combination of, say, very high open interest, very low volatility, and then you perhaps determine the direction with on-chain and funding rates, which are very good for determine upward or downward, forecasting. Then you get, you may get a sense of, okay, something's about to happen. And then if you get the correction right, you can have an expectation of what's been going on, right? But let me give you an example of 2018, that same example. That period, whenever we found a floor in 6,000, we always found negative funding rates and a discount. So for the most part, derivatives were under spot price, which was very healthy, and that pretty much held the market for 6 months. But then you get an exogenous event, mainly the hash wars in this case, where you started seeing that huge spike in the price of derivatives compared to spot price. So it was at the very peak of that descending triangle of sorts, where you saw that complete shift in sentiment almost after half the year, right? Where pretty much the spot selling became prevalent. And that was a period of about, let's say, 2 or 3 weeks. A lot of on-chain had given you signals of, bearish sentiment, or let's say at the very least lack of buying from that period during those 6 months of compression. But you started to notice, a huge contango in expirational futures, and then huge funding rates, very high positive funding rates. And that happened at the very last stage before the capitulation, right? So if you would translate that to now, you may get some hints of lack of momentum. And at the moment, derivatives in general are extremely bullish, actually, right? You have severe discount, consistent, which is very important. The longer the signal, the better the signal. The more consistent, the better. We already had a huge wipeout in long open interest at the top with this recent correction. And now we're seeing the inverse, right? Most people, most likely going short because open interest keeps rising, yet the derivatives remain at discount on their spot, right? So the expectations is you would see upside in terms of price. Now, this may flip, right? We may keep consolidating after a few months and have expectations of, a very bullish market, consistent funding rates and all that stuff. And then at the peak of low volatility, we see a shift, and then the narrative changes, right? So it's hard to make that expectation. The context now is, okay, you have, let's say, low activity on an on-chain level, fair enough. But once you get to, the moment when let's say speculators actually decide on the market and where the auction has to take place next, meaning another bracket of speculations on the upside or the downside, that point is specifically hard to predict, and you would need sufficiently low levels of volatility to start making decisions in terms of risk, depending on what you want to do. Because at the same time, you can speculate on two scenarios, right? Let's say the market decides that was the top, and that we need more correction to 30K or even 20K, to give you like an extreme worst case scenario. That would happen after a sustained period of premium from derivatives over spot. Keep seeing a low activity on chain by all the metrics I've mentioned, and perhaps more distribution and more profit taking. A rising coin is destroyed, coin mean age, dormancy, all the things that denote that there's a lot of movement from all coins going into exchanges, and a break in that pattern that we've seen, where exchanges have consistently diminished their BTC supply holdings from the market, denoting that there's a lack of selling pressure in the market. That's healthy. But so it's pretty ambivalent, but there's going to be a point where volatility is low enough that the expansive movement is always pretty much imminent, and speculators make their decision, and you have either the major correction or the pump. Now, network activity, assuming the second scenario where we pump, there's a scenario where retail may regain some interest in the market and decide to pull in again. But that would happen with new all-time highs and new prices. Usually retail, especially the new money retail that is inexperienced and is not accustomed to buying capitulation or complete blood in the market, those guys usually wait for new all-time highs. They start buying with where people with experience, let's say institution, early adopters, all that stuff, would start taking profits, right? So we would need that kind of pump in price to see that correlative increase in network activity. But I don't know. We'll see what happens. I digress.
Thank you for the good summary, David Puell. It's interesting to see how the scenarios roll out in the future. We are now moving on to our second phase of discussion between David Puell and CryptoQuant verified authors. The question would be asked from CryptoQuant verified authors, and we have prepared some of it that our users are probably curious of. So let's start with CryptoVizard asking his questions.
Hello everyone again. Yeah, I think my question is better be started with the MVRV and David Puell multiple itself, because he's here and it's good to ask him. These metrics are really correlated with the price itself, and as you explained perfectly, the market dynamics has changed. But if you could just talk about the behavior of the MVRV metric, which is, I think, one of the favorite metrics for everyone, at least for me when I got into this space. It was really, really interesting, the concept and everything. The behavior of MVRV has changed a lot. And as you explained, the new players could be the reason. But what is your explanation, especially about the bottom, like the lower band of these metrics? Like we had like 50% drop in the metrics. We didn't see the numbers close to 1. As soon as market hit like 1.7, 1.8, it is like the new momentum was created in the market. Do you think the reason that the behavior change is due to the new players. They all have access to on-chain data and they look at the levels and they react to it, or no, it's just totally something correlated with the price, and we should expect a change in the all metrics that are correlated with price anyway.
I'll answer the question in several portions. First off, the MVRV has many iterations, right? And I personally, despite the fact that I'm the co-inventor of it, I actually prefer the C-score version for MVRV. I think it's cleaner to see or cleaner to get a signal from. So for people who don't know, the C-score version would be your regular statistics C-score, but assumes that the realized gap is the mean, right? And that's how you populate the data. That was actually innovated by Owen Wonder way back, which is an analyst who I think left the market, which is a major loss. He was pretty good. In any case, so I actually use that one because it's a volatility adjusted version of MVRV. That's why I expect MVRV ratio to be diminishing. Let's say it's going to keep making lower highs every cycle. That's why I prefer the Z-score version. Because if volatility also diminishes through time, you need to pretty much adjust everything for that reason. The fact, going back to one, we didn't go back to one because at least until the current environment, a bear market is pretty much not confirmed. That only happens every, full-blown multi-year bear market. So the signals are pretty scarce. And I think we've had, going under, mainly under, because that's the main signal, right? If MVRV is under 1, market cap under realized cap, that's the signal where you should be accumulating, perhaps accelerating your DCA. Last time that happened, I think it went down under 1 briefly in the COVID crash, and then before that, in late 2018, which was obviously the bottom of that bear market. That's the reason I see for not going into 1 as of now. It's still relatively healthy, although ambivalent and suspicious, let's just say, or cautious in terms of the lack of network momentum. It's still within the bounds of a healthy bull market. And you wouldn't expect going to 1 or under 1 for until the next major bear phase. After a year or of constant downside. So yeah, that's mainly the reason I don't think it has much to do with market dynamic at this stage. It may play out later on, but at this stage it's just I've seen regular behavior from MVRV, and the fact that we haven't seen seen it go up as much as previous cycles is because in the specific ratioed version, you don't have volatility adjustment. Therefore, it's going to keep making lower highs. But in other adjusted versions, you still see reliable oscillation between buy and sell thresholds.
Yeah, wonderful. I think I'll ask the next question and then pass it to Yan if he wants to ask a question following my question. You explained about this part in your first part. In the first part, you were talking about the overall picture in 2021. But I think, especially nowadays, there are a lot of discussion about Plan B's model and all similar on-chain models that they're trying to somehow model the supply part of this story. My question is, because everyone here know that the story will be completed with the supply and demand. What is your favorite metrics, especially in on-chain world, that you use to gauge? I know it's hard to predict the demand. It depends on a lot of factors, like it could be the macroeconomy and like COVID, the fear in the market. But what is your favorite on-chain metrics that you use to map or gauge the demand in the market, besides the active addresses? Because I think that's obvious. But do you have any favorite model, or any metric that you use, or combination of them that can be used for the on-chain analysts or people who are interested in this field to gauge the demand in the market?
Well, MVRV, but C-score version. I use it more for a wider cycle, very long-term analysis. For shorter to mid-term analysis, SOPR, I look at it, for the most part every week, if not every day or two. I think it's one of the best metrics around. There's few variants on that. I actually built, in my collaboration with ARC, we built a variant of that, which is a short-term supply in profits divided by short-term supply in loss. That metric specifically is very useful, and it gives you similar signals to SOPR. And the way it works, I don't know, for people not familiar with on-chain and the lingo, it pretty much gives you the bottoms in bull markets and the tops in bear markets, because it pretty much detects via on-chain expenditure whenever the market in aggregate is at break even. So the assumption first principle says, if you're in a bull market and you have a period of upside and you go back to the aggregate of break even, for the most part, that's a bottom, at least as expressed in these metrics. And vice versa in the bear market. Whenever you get the top, it correlates to that break even. And what's happening is basically, in a bear market, for the most part, whenever you go back to break even, selling renews, right? You have constant selling pressure, lack of buying sentiment, so price always goes down, and vice versa in bull markets. Whenever you go back to break even, for the most part, the bad buyers go back to non-profit and therefore capitulate, and that pretty much sets the end of sellers at that stage, and therefore the market goes up again. What other metrics? I also look at exchange balances, just to keep an eye on how if they the whale institutional players are still holding their positions. I look at the inflows and outflows from exchanges and the ratio of it. What else? I actually go into a more, let's say, if you read the ARC article, it divides the metrics into three. And the first one is network health. And for that, maybe a weekly revision of an aggregate of hash rate, transaction count, transaction volume, or even MVT, and active addresses, just to get a sense of the general network activity, mempool, all that stuff. But that's pretty lacking in concise signaling as an active manager or a trader more specifically. But what else? I think that's for the most part, that's it. That's for the most part what is not proprietary that I use on a consistent basis. I look at a few other metrics from time to time, but they're too long term, or they have much more noise that I would like to. The other ones would be perhaps dormancy, coin days destroyed, stuff like that, just to keep an eye on if there's a lot of potential selling pressure in the market. Keeping an eye on old coins and making sure that they're not being circulated back into the market. And I think that's it, off the top of my head.
Perfect. Yeah, 100% agree on that. Especially now, they're distinguishing the long-term and short-term holders for SOPR. That's even making it more interesting, especially for finding the top and bottoms in the bear and bullish market. So I pass it to Yan. I think he has an interesting question himself.
Yeah, hi again. Hope I'm not breaking up. Seems like Twitter Spaces have some issues with Android phones, but yeah, thanks, Crypto Wizard, for starting the discussion. I think you have already talked about like the MRV score as one of the metrics to determine general market cycle tops and bottoms. What else are you looking at to determine whether we have reached cycle all-time high, cycle bottom? What metrics are you looking at there?
Historically, well, apart from the ones I've already mentioned, cycle tops. I think Phillips Ruddle, I think that's the name, Ruddle ratio, I think is useful specifically for market tops. I mean, for market tops, you usually look at confluence, right, of a large amount of metrics giving overextension. It's basically mean reversion, even if you're using on-chain. I mean, the people, market analysts are usually familiar with mean reversion in traditional markets. You know, your 200-day moving average, all that stuff. The 200-week moving average of Bitcoin has been quite reliable in detecting bottoms, almost to the T. It has been quite impressive. I don't know if that's going to keep up, but so far it's been useful. But when you're dealing with long-term aspects, you know, if you go back to, that's perhaps the only free lunch we get as market participants, mean reversion as a tool, and we still apply it to on-chain. So whenever you see a severe dislocation in mean reversion, whether it's MVRV, 200-week moving average, even coin is destroyed, you can apply different mean reversion mechanisms to it, or functions to it. If you see a historical confluence of that, as we actually saw a little bit in the beginning of 2021, that's suggestive of a top, right? At the very least, you shouldn't be buying or longing or something like that. For the bottoms, specifically with Bitcoin, it tends to deal more with you know, okay, you notice the overextension at the tops, but for Bitcoin, it tends to overshoot or overextend to the downside. Specifically, let's say when market cap goes below realized cap, as opposed to bottoming at realized cap, right? So it tends to overshoot in bear markets. Once you have your insane exuberance in the later stages of the pump, then you have the multi-year. It doesn't stop at mean reversion. It doesn't stop at break-even, general break-even, aggregate break-even. So overshoots that, but it doesn't overshoot as much as it overshoots on the upside, which is quite good. So people keep looking for a bottom and lower prices, but they tend to never come. I think that's more than stock flow, one of the good market properties that Bitcoin has in its scarcity model, that whenever you have overextension to the downside, it's diminished proportional to overextension on the upside. For that, I think I'm one of the guys who has tried to get a sense of a few metrics that get the bottom, the exact bottom, as opposed to realized cap, where it shows you just a general area where you should be accumulating or DCAing. But delta, balance price, or the capitalization versions of that, those are useful for getting the bottom. We still have to try them out in the next cycles. Whenever we get a new bear market, it's going to be we still need to generate new samples into confirming their use. So far, so good, but nothing is magic. In any case, I think those two specifically, let's say balance price, investor price, delta price, at least as a confluence of those are good bottom detectors. Whenever you see, this is for cycles, for, let's say, multi-year cycles. And again, for midterm price movements, once you have the correct narrative, okay, we're in a bull market, okay, we're in a bear market, then you can use stuff like SOPR and short-term holder, supply and profit loss ratio, stuff like that. And you can go and well, specifically for midterm, the other metric which I find extremely useful would be a combination of open interest and derivatives premium and discount. It's very useful to look outside of on-chain at times, and I think those two specific metrics are extremely useful. The options market is not liquid enough to give us reliable information. It's not mature enough, so I don't think that it plays that big a part. It's very mispriced still. We may get efficient signals from there, max pain price, all that stuff. But for now, I think looking at futures, perpetual, especially, and also aspirational in basis, contango backwardation, that's very useful as well for midterm movement, not for long term. Yeah, I think that's it.
Thanks for the long reply. Yeah, sounds like we still have to, when it comes to cycles, to take into account, of course, a lot of metrics, and also we have to still learn a bit on what to look at, if I got you right.
I guess I can take over now. So I was going to ask two questions, but you already answered the first one about the maturation of the market by institutional adoption and how it will affect the cycles. But I'm going to ask the other question, which is very I'm following very closely about the Lightning Network. So what's your thought about the Lightning Network and its effect on Bitcoin valuation models in the future? Since it's not an on-chain, how will it affect the models in the future if large number of transactions of small amounts happens in the second layer, not on chain? It's not like very high right now, only over 3,000 BTC, but it has been growing exponentially. I know from my friends, like my family, that they are introduced to Bitcoin first with the Lightning Network now, and then they open an account, and then like on the blockchain, like so it's the first like introduction to adoption happening lately, at least around me, with the Lightning Network, which we cannot see on on-chain metrics. So how will affect the valuation model in the future if large amount of small transactions happen on layer 2?
Two things on that. First off, I think that's a long way to go. Right now, if I remember correctly, we have 3,300 or so BTC in the standing in the Lightning Network. I think it's 18,000 nodes and 82,000 channels, right? Something like that. Correct me if I'm wrong.
That's correct.
So that's non-eventful right now. Even though we saw a parabolic rise or an sort of exponential rise during 2021, as you've seen, it has correlated with a lack of network activity underlying in other metrics, active addresses, transaction count, and all that stuff. So it has flattened out for the last month or two, right? It has stayed around those same levels pretty consistently from this three metrics I just mentioned. I would say it would start to affect metrics. Let's say when it gets to over 200K Bitcoin, something like 1% of the supply. And then you have to take into account how much of outstanding Bitcoin is still in circulation on a day-to-day, right? Long-term holders, for the most part, don't move it. Custodians also keep it, hold it for very long periods of time. So right now, I pretty much, with high degree of certainty, would tell you it doesn't affect the market, and it would start to affect the metrics. And it would start to affect them going into the 200K threshold, I would say, because we've seen major price movements or major market events driven by that amount of supply, let's say, right? So that's my expectation now. When will we get that? I think that's for the next cycle. I don't think it's going to happen on this one, because you have on the one part, even if let's go into the three major market actors, right? OG whales, early adopters. I think most of them, and perhaps some institutions, are the ones trying out Lightning Network, right? And that makes sense. They were the early adopters in Bitcoin. Makes sense that they're the early adopters of LN. So I think most of the traffic will begin with them, but as of now, it's pretty mild, right? For the most part, they're just holding it for a very long period of time, assuming the coins are not lost. And then on the other hand, you have institutions which are barely getting into the asset. Even what's your major institution who got into Bitcoin? And this is GBTC, I don't know, ARC perhaps, 2015, 16? And that was GBTC, right? So for the most part, major institutions are getting into the asset itself, as proprietors, let's say, of actual Bitcoin, as opposed to GBTC shares. That exposure came in early 2020 for some, COVID crash for others, late 2020 for most of them, right? And that's what drove price up from September into early 2021. So they're pretty new to the market if you look at it in relative terms. And they have had an influence in the market itself, but not in Lightning Network. So I would expect pretty much a very delayed interest. And that's not their job in that sense. Their job is to actively manage the asset itself. Their interest in the Lightning Network is as a mechanism as a layer 2 solution more than any sort of investment. So for the most part, I expect them to, all that traffic, all that supply is going to be held in, off the Lightning Network. And then retail, we're seeing some lack of activity even coming from retail. I don't expect that to expand into the Lightning Network for now. So I think it's for the next cycle. And that parabolic rise we saw in the Lightning Network this year, I think most of it was driven by experimentation. Sorry, you have, okay, so if you have 3.3K divided by 18,000, that would be 0.17 or so, right? Bitcoins per node. So that's, in aggregate, that's a pretty experimental amount of Bitcoin, even for an OG. We're talking about people having hundreds, potentially thousands of Bitcoins. And the average amount is just 0.17. That denotes so far is just experimentation. So I think Lightning Network is at not even at 2013 stages of adoption, it's at 2011 stages of adoption. So perhaps you can gauge a 10-year delay in the asset as Bitcoin gets more adoption. And it actually needs that transactional efficiency, right? So I think that's going to come, but at the very least 5 years, later stages of the next cycle. And you're still going to see that parabolic rise, right? Maybe by next cycle we get 30,000 Bitcoins, which is a 10x increase, quite healthy, but still very experimental, right? I mean, so I don't know, we'll see. I still think it's going to take a while.
I understand. Thanks for answering. I think Ho-Chan has some questions before we wrap up.
Yeah. So after my question, is it okay if I give our audiences one or two of them to ask questions to you, David Peull?
Yeah, for sure.
Yeah. So my question would be, is there any metrics that you like from our service, from CryptoQuant? What's your most viewed metrics from our service?
Sorry. I like, well, the standards, as have you mentioned. I don't want to like repeat MVRV again, but a lot of the metrics I've just mentioned throughout the conversation, right? I like the particular angle of CryptoQuant that integrates a combination of on-chain and exchange level or market level metrics. I actually like the iteration you guys gave to the miner outflow multiple, which is a C-scoreized version of it. Correct me if I'm wrong, right? What miner outflow index? That's the correct name. Is that right?
Yes, miner's position index. That is correct.
Exactly, which is as a yearly C-scoreized version of miner outflow multiple, right?
Mm-hmm.
Yeah, I like that one. I actually think that's a precise example of how a lot of the, with a lot of these metrics, I mean, for the most part, statisticians hate the fact that you have to extrapolate additional functions to your previous formula. Let's say applying a C-score to MVRV as opposed to keeping it just as a ratio. But for the most part, C-scores are very useful in adjusting for volatility, pretty much any metric, not just MVRV or miner outflow multiple. I think it's the way to adjust for volatility, any on-chain metric. I think you guys have, correct me if I'm wrong, a few metrics that are I don't find in other service providers. One of mean coin age, I think that's one of them. So I get that from you. Or at the very least, I get that from you. That's for sure.
Yeah, we provide in coin age and some coin age too. Yes.
Yeah. I find that again to keep the detection of that holding behavior and you know the consistency and on moved coins. I found that very useful. I think those were it, top of my head.
Thank you, David. I think Crypto Wizard has one more question, and after his question is done, we'll collect one or two questions from our audience. So please request us as a speaker if you want to ask David Peull any question, and I'll pass on to Crypto Wizard.
Yes, like I try to keep it short, and while we're waiting for the audiences to join us, I think you answered this question, but still, I like because I have no experience in other markets, but looking at the spot market and future market, the monthly volume, the aggregated monthly volume for spot and future is like in May 2021, it was close to $2 trillion, even for future market. And seeing this volume of trade in the future and the spot, it was almost equal, and it was even more than the market cap of the Bitcoin itself. What is your take on that? Is it normal a market like Bitcoin has that much volume in the future? Because I don't have any comparison in my mind made with the traditional market, but it sounds a little bit off, like that much volume in the future. What is I don't want to look for the reason because you explained it perfectly, but do you think is it healthy? That's right. It's going to be just affect the pricing part of this like market. But what about diminishing the demand by just flushing out the newcomers? Because I think most of us are agreeing on the fact that the newcomers tend to join the future market, and this volatility, this big weight by the future market is going to just push them away, scare them away, and distract the capital that could have go to the spot market and just build the price up, build the momentum. What is your thought on that? Do you think this is healthy?
Okay. So by volume, you mean exchange volume, especially on derivative exchanges?
Yeah, like the aggregated traded volume on the derivative. It was close to $2 trillion.
Yeah. So volume from derivatives versus spot markets, right?
Exactly, and a monthly aggregated volume.
Yeah, I still look. The CME, even in traditional markets, you see an overbalance into derivatives much more than spot price, despite the fact that price discovery happens in spot. You always see, or you have several instances where you see derivatives market outpacing in terms of volume the spot market of the underlying. So that's not new. I actually get pissed off whenever people that say that BitMEX, for instance, or substitute whatever offshore unregulated derivative exchange. Whenever people say that, for instance, BitMEX was the main cause of the 2018 bear market, I literally get pissed off. I don't believe you can like pretty much point out and keep. Well, I mean, we're working. We've worked on something that I'm not gonna state right now, but you can back me up on this. Like you can see pretty much the narrative of how every single long-term, I specify, long-term price movement in Bitcoin can be explained from first principle by a fundamental cause that can be confirmed. Not only that, it can be confirmed via on-chain. To give you the most specific example, most of the market structure in 2019 was caused by the Plus token scam, right? The pump and the dump. So had nothing to do with BitMEX. Same thing. What's the reason why in 2018 nothing happened, or bear market corrections, blah, blah? Nobody was buying, right? It was a natural corrective movement after a huge bubble driven mostly by retail, which had completely left the market by that point. And at the time, there wasn't any institutional interest except for a few new hedge funds from, few earlier adopters that came off the traditional markets into the crypto markets as a hedge fund or whatever. I mean, the AUMs for most of those funds relative to traditional funds was much more diminished. I think for the most part, funds were around, let's say, AUMs between 5 million and 50 million. And very few exceptions that go above 100 million, right? Which is, in comparison to traditional finance, quite small still. Now, the actual Wall Street players, I mean, those funds right now are very large because, they survived the bear market, they accumulated, they higher price, all that stuff. But the actual legacy Wall Street types truly got into it for, with very few exceptions like ARK, truly got into the market as soon as COVID happened. And they were pretty much looking into inflation and, assuring returns pretty much on any asset, including Bitcoin. So I'm very, very skeptical of the fact that derivatives market have a cause on any bear market or even any bull market. I actually think for the most part, the retail that comes into Bitcoin first does so in spot price. In my experience, most of the acquaintances I have, most of the people I've talked to, they only go into the bear market and actually stay as holders or DCA or stuff like that. If not, they get wiped into the market, and that capital is not that significant anyway. And if you take that into derivatives, if you have like one ambitious retail guy with absolutely no experience in crypto or in traditional markets or anything, I mean, he gets liquidated in 3 days, right? With very small amount of capital, right? So for the most part, I don't think it plays a very big role in terms of being healthy or non-healthy for the market. I think it's just a natural progression of the financial adoption curve for any asset in, you know, at least from the 1970s or 1980s. So yeah, I think for the most part, long term, everything can be explained fundamentally. The short term, you know, let's say 10% to even 30% price corrections, like the one we just had, or even the previous one a little bit, right? The May correction. I mean, that was a 50%. It had a lot of fundamental factors, but the overextension to go into a full 50% correction was, yeah, a lot had to do with high open interest in derivatives. So in the short term, both to the upside and to the downside, it compounds the price movements in corrective or impulsive moves, for sure. But that's just a shorter to, let's say, midterm, if we were generous, price behavior, right? As opposed to something that happens 6 months to a year, like plus token, or the new money institutional adoption coming from March last year up to now. So I don't think it's unhealthy for the market at all. I'll just leave it at that.
Oh, great. I think everyone here had a really good on-chain class today, like including me myself. Like it was a great honor. I think it's time to pass the time to the audiences to ask the question. Thank you, David. It was really great to talk to you, and Happy New Year in advance.
Thanks. Happy New Year.
Oh, thank you. So the next question will be raised from our audience. Let's start with CoinInfo, who has requested me first, and then we'll move on to crypto.
Hi, David. As just a normal retail investor, we always wish to spot some institutional movements, and I think the closest metrics that is available to retailers is the Coinbase Premium Index. And you know, like Coinbase is known for custody services, so do you think that this just approach to spotting institutional movement is appropriate?
Yeah, for sure. I don't look at it that often because I don't know. I'm already gets to a point where you cannot like look at everything every day. So I look at it perhaps twice a month, something like that, just as a general context, or maybe after a corrective or impulsive movement, something like that. I do think that Coinbase is at exchange level extremely important, and CME, you know, as two major institutional hubs for diagnostics institutional behavior. Also, to keep it, I think it would be simpler for retail. Derivatives premium discount, but calculated via BitMEX. BitMEX is a little bit special to me as compared to Binance or Bybit, despite the fact that it has lost a lot of market share and open interest. But it's important because I think it has the most robust oracle or index price, and a lot of that index price is based on the, you know, the pricing in Coinbase and other regulated exchanges in spot. So I tend to look at that pretty much every day, and from time to time to the Coinbase premium. But yeah, I agree with you. Coinbase plays at least for now, has played a central role in diagnosing market behavior from institutions.
Great, thanks, David.
Crypto Maverick, you're on next.
Hi guys, yeah. Actually, I want to know. There are a lot of altcoins listing recently, so the money is flowing to altcoins in general. So, how do you see this? This is very good for Bitcoin, or like how right now. I want to know where is the price range. Like a lot of sellers are coming into the market, and according to your metrics, there is a drop. Like the price range, exact range. So if you give some details about that, it will be useful for me.
I'm sorry, can you repeat the last part of the question?
Yes. The what price range? Like around 60K, 44K. Like you can see the lot of drop in your metrics. Like.
You mean the network health metrics?
Yes.
The ones I think that's been going on since the top at earlier in 2021, like spring 2021. You see most of those metrics stay flat for the most part. Let's say hash rate. Since the China ban, it corrected and then has been pretty much flat, as opposed to, hash rate traditionally just keeps rising and rising. And so far it hasn't made, convincing new all-time high since China ban, for instance. I think that's the same case for active addresses, transaction count, etc. That's the question, or am I missing something?
And also I want to know, like, still there are large whales are holding, or like, how do you track, like, daily or weekly or monthly, on what basis, or like hour to hour, or like?
You mean when I'm that's
yeah, because it's very difficult to track. Like one time, like couple of hours, you can see like a lot of whales will be in the market. Then after a couple of hours, there is a drop in whale. Then price again drops. Then again after a few days, then whales again step into the market and push the price up. So it's pretty hard to say, right? So there is always skeptical in the market, like which way it goes.
Yeah, well, personally, I mean, I've been pretty much, I've been active in several time frames in the Bitcoin market since, but right now, I'm mostly a mid to long term active manager of
Long term means like monthly time frame or yearly time frame?
Yeah, like I can tell you right now, sometimes I don't trade for 2 or 3 months and then I go back to it. Since the bull market, I've been pretty chill. But
and also
when I do get
yeah,
but I never day trade anymore, and I never go into the very short term, like ever. And that's just a personal decision. So what do I do for tracking that? I mean, most of the things I've mentioned in the conversation, that's what works for me in a, let's say, multi-week to multi-month perspective for the most part. And then the rest is just waiting, patience, and even forcing yourself off charts. But that's just me, right? Like I've seen day traders who make a lot of money, and it's just depends on your style and how you manage your portfolio and all that.
Thank you. So we are going to move on to our last audience question. JDiv, you're on next. JDiv?
Hi, can you guys hear me?
Yep.
Oh, great. I just jumped into the chat and just wanted to say I'm a big fan of all of y'all, and thank you for hosting this. That's it. Thank you, guys.
Got it.
Thank you.
Thank you. So we're going to be ending our on-chain 2021 retrospective, looking into 2022 with David Puell session. Thank you for all of your time, especially David, Key, and all Secure Verified authors who has joined the call and the audience who has attended this event today.
Thanks for having me. Have a good one. Happy New Year.
Happy New Year.
Thanks, David. Happy New Year.
Thank you, everyone.
Bye, everyone.
Happy New Year.
Thank you, everyone.
Thank you. We'll be sharing our summary of today's call shortly within this week, so everyone can also check the details.